Greetings, everybody, and welcome to our first educative session at the ZED Future Hub. So today we're really excited to have a guest that's going to take us through how young people can invest in government bonds as well as Treasury bills. So this is really exciting. My name is Caro Milambo Mfana, and I'm a co-founder and voluntary CEO at the ZED Future Hub. So the person that we're going to be talking to today happens to be a volunteer at the ZED Future Hub, and we are very excited to have him as our first guest. So I'm going to be the moderator for this particular session as we go through government bonds and treasury bills.
Thank you so much, Caro. My name is Chiko Siakalima. I'm in the finance sector and also a volunteer at the ZED Future Hub. I'm so delighted and excited to be the first guest on the ZED Future Hub. So we're going to be discussing government bonds and treasury bills. So I'm so excited. I think we can get into it. Our topic of discussion is government bonds and treasury bills. So government bonds and treasury bills are simply instruments that the government uses to borrow money from the public. So you as an investor would actually lend money to the government and you would enjoy the benefit of making some interest of the borrowing, the lending of your money to the government. So I think we can get right into it at this point. So I'll, at this point, run you through the differences between or comparison between government bonds and treasury bills, because these two instruments are a bit different. So what is a government bond? So a government bond is a long-term instrument that the government uses to borrow money for periods more than a year, while a treasury bill is a short-term instrument that the government uses to borrow money for periods less than a year. So another difference that we can highlight is that government bonds are issued at a par discount or a premium, while as treasury bills are issued at a discount. So for government bonds, the tenure ranges between 2 to 15 years, while as the tenure for treasury bills ranges between 91 days to 364 days. And there are also differences when it comes to return on investments for government bonds, as one gets to receive a coupon every 6 months, and initial investment amount which is received at maturity, or for treasury bills, return on investment is received at maturity of the treasury bill through what we call a discount. So government bonds auctions occur once every month throughout the year, while as for treasury bills, auctions occur twice every month throughout the year. So these are some of the comparisons between the government bonds and the treasury bills. So at this point, we'll move on to our next topic of discussion. So at this point, I'll run you through some of the common terminologies that we'll come across during our discussion. So the first of which is we've got the face value, which is simply the amount that the government promises to pay you at the end of your investment or your maturity. Then we have cost value. This is the money that you lend to the government at the beginning of your investment. Then we've got a discount, which is the difference between the face value and the cost value. Then we have maturity period, which is how long you lend the money to the government. Then lastly, we have what we call a coupon, which is a fixed cash flow paid every 6 months by the government to bond investors. So earlier I mentioned that government bonds are issued in 3 different ways. So we've got what we call issuance at par. So issuance at par occurs when a bond is issued at a coupon rate that is equal to the interest rate or the yield rate. Then we've got what we call issuance at a discount, which occurs when a bond is issued at a coupon rate that is lower than the interest rate or the yield rate. So the third one is issuance at a premium, which occurs when a bond is issued at a coupon rate that is higher than the yield rate. So at this point, if you could allow me, I will share an illustration of how government bonds are issued at par and how government bonds are issued at a discount. So during this discussion, our main focus will be on issuance of government bonds at par and at a discount. So should be quick to mention that as of January 2024, Bank of Zambia released a pronouncement to say that government bonds will no longer be issued at a discount, but instead they will be issued at par. So let me take you right through what I've prepared. As you can see, we have two different types of bonds here. The first scenario, the first illustration has the old issuance before the pronouncement that was made at January 2024. So on the first scenario, we have a bond that was issued at a discount, which has a tenure of 5 years and with a cost amount of 8,500 with a face value of 10,000. So this particular bond has a yield rate or interest rate of 20% and a coupon rate of 14%. So I'll run you through how, apologies for that, I'll run you through how the issuance of government bonds at discount was previously accounted for. So in this case, for the first scenario, the initial investment amount is the cost, which is 8,500, and we have a face value of 10,000, which is the amount that you receive at the maturity of your bond, at the end of the tenure of the bond. So previously, if one invested in this kind of government bond, they would benefit from what we call a discount, which is basically the difference between the face value and the cost of the bond. So you get to invest 8,500, and what you get to receive is 10,000 when your bond gets to maturity. So, however, this discount of 1,500 is received at the end of your investment. So one gets to also benefit from what we call the coupon, which is paid every 6 months. So in this case, our coupon will be 14% of the face value, which is 1,400. But this coupon rate of 14% is actually a rate that is given per annum. So since coupons are received every 6 months, what the bond investor gets to benefit every 6 months throughout the tenure of this bond is that 1,400 split into 2, which is 700 kwacha. So I must mention at this point that coupon is subject to a handling fee of 1%, which is paid to Bank of Zambia, and it's also subject to withholding tax of 15%, which is paid to ZRA. So in this case, our handling fee will be 1% of our gross coupon amount, which is 7 kwacha, and our withholding tax will be 15% of the coupon amount. So hence our net coupon amount in this case will be 700 kwacha minus the 7 kwacha handling fee minus the withholding tax. So this amount of 588 kwacha is what one gets to benefit every 6 months throughout the tenure of this 5-year government bond. So at maturity, what you get to receive is actually the face value, which is 10,000. So if you can see from this illustration, your initial cost is 8,500. That's the amount that you get to invest. That's the amount that you lend to the government. But at the maturity of this bond, you get to receive 10,000. So you've got a component of a discount of 1,500 here, which you get to receive at the end of your investment. So this discount of 1,500 was previously not subjected to any tax. So in our second, I'll take you to our second scenario here, where we've got the new issuance of government bonds at a par. So we've got a 5-year bond at a cost of 10,000. So for the issuance at par, the cost will be equivalent to the face value, meaning that the initial amount that you get to invest is the amount that you get to receive at the maturity of your bond. But the benefit with this kind of issuance is that the yield rate here will be equal to your coupon rate. So if I can take you back to the first scenario, we had a yield rate of, let's say, 20% and a coupon rate of 14%. So in this second scenario, the yield rate is equal to our coupon rate. So meaning our coupon rate will be higher in this case. So for issuance of government bonds at a par, there's no component of discount. So meaning that one gets to benefit from a higher coupon rate, and the benefit is through the fixed cash flow, which is higher in terms of coupons. So if we were to calculate our coupon rate in this second scenario, our coupon rate will be 20% of our face value, which is 10,000. So our coupon here is 2,000 kwacha, and our handling fee is 1% of this coupon rate, of this coupon. Which is 20 kwacha, and withholding tax, which is 15% of the coupon amount. Sorry, let me just take it back to this 2,000. So this 2,000 is a coupon that you receive per year, because this 20% is a rate per annum. So the coupon amount that will be received every 6 months will be half of the 2,000, which is actually 1,000. So our handling fee in this case will be 1% of the 1,000 instead. which will be 10 kwacha. With holding tax, every time we receive coupon will be 15% of the 1,000, which is 150. Hence, our net coupon every 6 months throughout the tenure of this bond will be 1,000 less the handling fee, less the withholding tax. So our net coupon amount is 840 kwacha. And at the maturity of this bond, what we get to receive is the initial amount that we invested, which is the 10,000. So if we compare the two, what you get to notice is that in the second illustration where the government bond is issued at par, one gets to benefit from a higher coupon rate as compared to the initial one where one gets to get a coupon plus the discount, which is 1,500. So this is the difference in terms of issuance between government bonds issued at a discount and government bonds issued at par. The total net coupon amount over the 5 years would be 588 multiplied by 10, correct? Because the tenure for the government bond is 5 years, but we receive the coupon every 6 months. So this would be the total net coupon amount. As for the issuance at par, the net coupon amount would be 840 multiplied by 10 coupon payment, which is 8,400. So for the first issuance, one should remember that you also get to benefit from the 1,500 discount. So the total in terms of what you get to make in return on investment would be this amount here, 7,380. So as for the issuance at par, the amount that you get to make on investment of 10,000 would be 8,400. I hope that's okay.
Yes, that's fine. Thank you so much. You can proceed.
All right, thank you so much. So at this point, I'll take you back to our PowerPoint presentation. So we'll move to our next point of discussion. So our next point of discussion is we'll go through a few frequently asked questions about government bonds. So the first one being, who is eligible to invest in government bonds? So individuals, business firms, institutions, and foreign entities are all eligible to invest in government bonds. So second question is, how can one qualify to invest? So for one to qualify, they should have a Central Securities Depository account, which is a CSD account, and a local bank account denominated in kwacha. So the third is, how can one sign up for a CSD account? So for one to sign up for a CSD account, one can sign an account or can open up an account through the Bank of Zambia Investor Portal or through their local commercial bank. And what are some of the requirements for opening a CSD account? So for one to open a CSD account, one must have a copy of a certified NRC, a TPIN certificate, a passport size photo, a signature mandate, and a valid email address. And what is the minimum amount that one can invest? So the minimum amount that one can invest in both government bonds and treasury bills is 1,000 kwacha. So if you could allow me at this point, I think I can run you through how one can navigate their way through the Bank of Zambia investor portal. So previously, for one to open a CSD account, one had to go through a commercial bank. But now Bank of Zambia has made it easier through the introduction of the investor portal. So all that one needs to do to open a CSD account is on Google site, type Bank of Zambia investor portal. So a link will pop up under Government Securities Investor Portal. Then you can click to open the link. So this will take you directly to the Bank of Zambia Investor Portal. So for one to sign up for an account, all you have to do is click on Create Account. So to start the registration, you need to input your email address and your username to start with, and then create a password. So this is how one can navigate their way through the creation of a CSD account. So some of the requirements that will be needed are the ones that I highlighted earlier in the presentation. So I can run you through a demo of how the investor portal looks like once one logs in. I hope that's okay with you.
Yes, that sounds amazing. Thank you so much.
All right. So once you enter your login credentials, you get to receive a one-time PIN, your email address, which you have to enter before logging into the portal. After you receive the one-time PIN in your email, enter it here. You can log in. So once you log in into the Government Securities Investor Portal, this is what you get to see. So on the first interface here, you get to see your total holdings in case you've made some investments either in treasury bills or government bonds. Then you get to see your portfolio here as well. Then you can also view your transactions. Then this is where you get to access under corporate actions. You get to make your bids under the heading that says bids. And you can also check out the auctions if there are any available auctions. We can discuss a few benefits of investing in government securities. Government securities are free from default, meaning that the government will always honor its promises to pay the investors. So one doesn't have to worry about whether the funds that they've invested will be received at majority of the government securities. So government securities can also be used as collateral for loans obtained from banks or financial institutions. And government bonds can also easily be sold off on the secondary market, either to banks or individuals. Other than this, some of the benefits in the long term would be government securities help with saving, as well as getting the benefit from the interest that's received from investing into these securities. So one can actually get to use the coupons, for instance, in government bonds to invest in other businesses as they are waiting for the initial amount that they invested in to mature. So this could really help the youth. So in terms of the youth, I would like to say, let's say somebody who's in school, maybe a university student, if they were able to save as much as maybe 1,000, we can actually place that into treasury bills, which can mature maybe in 3 months, or a government bond where they can get to benefit from the coupon that's received every 6 months. So this brings us to the end of our discussion, and I'm so excited and humbled and grateful to have made the call. Thank you so much. I'll hand it over back to you, Carol.
Okay, thank you so much, Chiko, for taking us through how to invest in government bonds and treasury bills. You took us through the differences between the two. And yeah, thank you very much for preparing this presentation for us. Due to time limitations, we'll have to end the recording here, but we'll encourage the viewers and those that are listening to put any questions they may have in the chat, and then we can get back to those questions and hopefully be able to provide answers to those questions. So thank you very much, Chiko, for being our first guest. And we look forward to even more collaboration in the future in the finance space. Thank you very much to everybody that has been watching this video and listening to us. And I wish you a good day.